In this video, we're going to take a look at payoffs on forward and futures contracts, and then relate to payoffs on options and some mapping then in Excel. So we're starting with a blank Excel spreadsheet. We're going to consider some maturity date on the forward or the futures contract. If we were currently in October 2020, and we were looking ahead to maturity October 2021, then we have a year on the forward or the futures position, and we would be considering what potentially could happen to the value of some commodity, let's say oil. And we could say, look, for a given period, like 1 year, oil could drop to $10 or go up to $190 or $200. So it's like a range of possible outcomes we're considering. And then we're saying, well, if we're taking a long position, if we're buying a long futures position, if we're taking a long futures position, that means we're buying the underlying commodity. So using the same type of notation that's in Hull, we would say the payoff on the contract here would be the difference between the delivery price and the futures price. So the futures trades on an exchange, and we're looking at the payoff, and we're using this bold italic F to indicate the payoff and the position. And then we're saying if we can identify that the delivery price, which is agreed today, K is the delivery price, and we're setting up a contract in order to purchase oil, let's say at $100 a barrel in October 2021, then how do we know if we're making or losing money on the position? That would be the difference then between the futures price, which we don't know currently what it will be, and then the delivery price, which we've set here at 100. And we hit F4 to dollarize the cell reference. That'll lock the cell reference. We don't need a comma, actually, and we take the difference between the two. Okay, so if we drag that down, come all the way down to 200 with the different payoffs, you can see that as the futures price goes up, the payoff on the forward position also increases. And we'll use an XY scatter graph and we'll fill in. Okay, so what we have here very basically is the payoff chart for a long futures or forward position, right? So forward and futures are basically the same, except one trades on an exchange. The forward position trades OTC. The futures position, typically there is an operation of a margin account, perhaps even real-time adjustment to the margin account. In the forward contract, there may not necessarily be that level of sophistication in terms of marking the market, but forward contracts do have sometimes some credit risk management. Key difference: futures trade on exchanges, forwards trade broker to broker or OTC. Okay, now if we consider this to be a long futures or a long forward contract, then the party who's the buying position, for each of those, there must be a party with a short position. So if somebody is buying, remember, long means to buy, so the buying position. And if somebody is buying, that obviously means somebody's selling. So to consider the payoff for a short futures, let's take our graph as we have here. We'll create a copy. That means when we go into the new worksheet, the diagram is linked back, or the chart is linked back to the payoff that we have here. Okay, so how do we change the payoff? Well, if we're selling, we have a selling position, selling oil, selling wheat, selling orange juice futures, selling pork bellies. Then we have the short position, so short denotes selling. And we could quite simply say, okay, the short position would just simply be negative the long position. So it's the reverse of the long. And that simply can be accomplished by putting a negative sign in front of the parameter and then dragging down, and you can see we have a different payoff type structure. So in this instance here, we have a short position. Somebody is selling the underlying commodity or bond or currency. We still have maturity, so we set the contract up today, matures in 1 year time. It's a delivery price, and that's our payoff. Now, if we follow more closely what we might observe in a textbook, it just would be simply maybe K minus the futures price is the payoff. And again, if we were to rewrite that, that would appear to be 100 K, the delivery price, will F4 minus the futures price, where each of these represents a conceivable futures price. Now that'll make no difference here. Once I drag down, we get the same result. Okay, so how do we then track the relationship then between the futures forward and the option positions? Let's copy again the long futures sheet. So we'll copy it, the whole sheet, long futures. We'll click here, create copy. In this instance, I'm going to create the payoff on the call position. So this is a long call. Let's work with that, long call, right? And in this instance, so we're going to be buying, it's a long, and it's a long call. Again, previously we had the payoff was F minus K. We might write maximum and S, but S at the terminal time period. So S, the spot price, the underlying price at maturity. Now that's the same as F at maturity, because F and S converge, and K here denotes, in this instance, the strike price or exercise. So we change the terminology and we say not delivery price that you're locked into, but in this instance, it's an exercise. So with the call option, you have the right to buy at the exercise, or sometimes better known as the strike price. Right? And to set up the payoff structure, very simply as before, maximum of S minus K or 0. So we are removing the negative region. In other words, if the payoff is not positive, if it doesn't yield us a positive payoff, then we walk away from the contract. And unlike the futures position where you're locked in, you're obliged to adhere to the terms of the contract. With a long call, if it doesn't have a positive NPV, we can walk away. And so the negative region is removed, and as a consequence, then we have a long call position, right? And we can see that there is a relationship then between the long call and the long futures position. The two are very closely allied, except here in this instance, there's no negative range, where with the long futures, there is you're obliged to honor the contract. If you're in a losing position, you've got to take that on board. With a long call, you can wait until maturity. If the value of the underlying falls below the exercise, you can walk away. In other words, only in the event of the value of the underlying increasing is it worthwhile exercising the option, in which case you make some money. So if you agree today to buy at $100 a barrel, or a bond at $100 in advance, and then at maturity, when the contract matures, you find that the oil or the bond actually is increased to 150. In that case, then you're making a profit of 50. If the oil price goes to 100, you are indifferent. If it goes below, you throw away the option. If it goes to 200, you make 100 profit. And the difference being defined as S minus K, where S denotes the underlying asset, the spot price at termination. Okay, now if there is a discussion then also in terms of European and American options. European options can only be exercised at maturity. Okay, what about the short? What about the put option? We could take the short futures and we'll move short futures. We'll create a copy, hit OK, and we'll say, in fact, I should have said link the short futures to long call, and we'll see long put, and we'll see why. So again, in this instance, it's a long put. Okay, so you're actually, you're buying the put, and the put gives you the right to sell. So it's a long, technically we're looking here at a long put option. Okay, and that gives you what? It gives you this put option. Previously the payoff here, maybe we could have referred to this as being C. Right? In this instance with the long put option, we'll refer to it as being P, put. And what the put option offers is it gives you the right to sell at some agreed predetermined price, which we refer to as the exercise. If it's not advantageous to sell at that price, then you can walk away. So it really is an option. And again, we're going with these values of 100 for the exercise. Then the put option, the payoff, can be defined as the maximum of K minus, maybe we will refer to this as S, the underlying spot price at maturity, if the option is European. And if the value is negative, we prefer 0. So it's always the maximum of 0 or the difference. If it's below 0, in other words, negative, will take, if this produces a value that's negative, we'll take 0. And to observe that then in terms of the graph, let's escape here, we'll rewrite, it's just basically maximum K being 100 minus the spot price, comma, 0, close off the brackets. Right, now we've the same basic shape until we get to 100, and then we'll have a set of zeros. Okay, in other words, if you have the right to sell something at 100, but it's trading the market at 50, well, that's worth 50. If it's trading the market at, let's say, 80, at 90, the underlying falls to 90. So you have the right to sell oil at 100, but the price at maturity in 1 year's time is equal to 90. Then the gain on that is you're able to sell something for 100 that's trading the market for 90. That's a gain to you of 10. If the value of the underlying is at 80, drops to 80, you can sell something for 100. That's really just worth 80 in terms of the market price, and that's a payoff. The value to you is 20. Okay, so we can rewrite this as being a long put option. Okay,